Welcome back, everybody, to the second official episode of the ASX Small Cap Wrap, where we are going to dissect a bunch of the recently released quarterlies that smaller companies on the ASX have to release at the end of April, by the end of April, I should say. And also going to talk about some of our recent writings on various decent quality stocks, some of them small, some of them not so small, that we like. And also, I'll cover off on a small cap, not so much a quality small cap, but a small cap micro cap that I recently bought. And I'll explain why I bought that one while still acknowledging that that's like a risky play that is probably not appropriate for most people. But before that, we've got our traditional disclosure and disclaimer. So over to you for that, Patrick.
Always happy to help with that. The hosts on this show may own shares in some of the companies discussed. They will not trade shares in the companies discussed for at least 48 hours following the publication of this show. The show is not intended to form the basis of an investment decision and is not a recommendation. Any statements that are advice under the law are general advice only. The hosts have not considered your investment objectives or personal situation. Any advice is authorised by Claude Walker, Authorised Representative number 1297632, Authorised Representative of Ethical Investment Advisors Proprietary Limited, ABN 2610-817-5819, AFSL 343937. The information contained in this show is not intended as and should not be understood or construed as personal financial product advice. You should consider whether the advice is suitable for you and your circumstances. Before you make any decision about whether to acquire a certain product, you should obtain and read the relevant product disclosure statement. Nothing in this
I'll
show.
jump in there. Look, that was great. I think that we all love hearing that every show. And at the same time, I just wanted to, put out there, essentially, it really is the main key takeaway is what you listen to us talk about here. It's sharing thought bubbles. It's catching up on news. There's no possible way in this format, as we have a chat about a stock, we could give you the kind of information you would need to make a decision. So these are just ideas that we're sharing, potentially give you ideas for what you might want to ask your financial advisor about, research yourself, or whatever your proper process is before you make investments, reading the PDS and all of that good stuff. But the idea is to share, what we are doing. We're going to tell you a little bit of information, and then you will get to decide whether, that company is worth you spending your time on. That's how we try and save time for you, essentially, by isolating, I guess, some of the things that might be opportunities without necessarily having figured it out ourselves. However,
I love it. A nice plain language explanation rather than the legalese.
We got massively distracted for totally good reason in the last few episodes because we're just talking about macro. Because look, let's face it, all the share prices were moving based on macro. And that was totally worth the effort because what did we manage to do? We managed to, this was the bit that wasn't really worth the effort. I sold out a bunch of my low conviction stuff, which is now will just bounce back to where it was. Completely pointless. However, the good thing about thinking about that sort of macro and the panic that first of all, the bad news that was on the horizon, and then second of all, the panic that actually came in April. I think we recorded an episode around that time about Panic Day, I called it. That was the day to buy. Far out, you don't get long. It's one day. Even that morning, it bottomed that morning, and then it shot up from there. I did a podcast with Owen on that very day, actually. And so, look, essentially, where that left me was, first of all, way more exposed to gold than I've ever been before because I bought a bunch of gold, which I still have. And second
Welcome to the club.
Yeah. And second of all, I actually think I did buy a bit more of like a Bitcoin ETF as well, though not much of that. I'd kind of held that from before. And then the other thing that I did was I just bought the high quality stocks that I like, usually large ones, not lower conviction ones, actual higher conviction ones. I bought some of them that were getting smashed pretty hard. And so that's what's really saved me because the lower conviction stocks tend to be smaller, riskier. There's one that hurts that's now probably 20%, 25% higher than when I sold it. I don't own it now, so I can probably talk about it. That was Fineos that I owned, and it's really taken off. I bought it like $1.40 something, and then I sold it at a vicinity of $2 when this whole stuff started coming out. And then it went down briefly and then shot back up to 270 now. So really sort of gave up some easy profits on that one through being scared. But I think it's important to share that to let people know that, while on one day I might seem smart because I sold at a high price and it went down, oh, well, a bit later it bounced back higher to my sell price anyway. So didn't achieve anything with that. Good news is, did put that money in high quality stocks that are also down, that did also go up. So the missed opportunity isn't as bad as it might seem at first glance.
I think if your portfolio is looking higher quality now than it was before, that's got to be a success, right?
It's a success because I'm still paranoid. I don't think that the Trump horror show is necessarily over. So because of that, it's probably a good thing that I'm in more high conviction stuff. But I did, the segue, actually want to talk about why I invest in small caps, which is not always my highest conviction stuff. Yes, I do have some high conviction small companies, but they're quite rare. In fact, in terms of truly small companies, there's probably only 4 or 5 that I'd say are really high conviction for me at the moment. The rest of them I would say is high risk reward. Now, I think that is the key concept to understand small cap stocks. You can basically, the way it works at this, and I apologize for the listeners that know this already, but in case we ever get any new listeners, I just wanted to put this out there. Basically, in the small end of the stocks, the market's less efficient. There are fewer people looking at the stock for a start, and there are fewer people that are able to trade in that stock. So a lot of the money out there on the stock market is in passive funds. Well, forget it. They're not buying the tiny stocks. A lot of the money out there that can buy smaller companies is in small cap and mid cap funds. But these guys all herd themselves. Even when so first of all, you got index huggy ones. They'll just buy it when it gets into the all ordinaries, which it can still be quite small when it gets into the all ordinaries. You have the index huggy ones that'll buy it for that reason. And then you have the ones that are truly doing something different, but they all still crowd around the similar strategies. And often the strategy that they crowd around in the small cap these days is they are looking for companies that have what it takes to grow and grow and grow until they get into those indices. In particular, they're looking for that ASX 300 inclusion, where there'll be often a lot of passive demand for the stock. It gives the fund managers an opportunity to take profits at a probably quite attractive multiple compared to whatever they bought prior. Now, I can't really fault the fundies for going for that strategy. I certainly do it myself. I have been doing it for a long time, been writing about it for a long time. It's hard to resist because you have dumb money, and dumb money is there being like, hey, look at me. Can you figure a way to outsmart me? And then you get some of me. So dumb money is great, but it's not going to get you all the way there, because as more and more people do this strategy, you have to be making the call about what's going to make it into the ASX 300 earlier and earlier. Like oftentimes when there's consensus around a stock will make it into the ASX 300, you see it getting to be a pretty crowded trade before that anyway. And it's not unheard of. And this is why I want to put a big warning out there for all small caps. There is one pattern that you may see in small caps that is that a hype stock will get all the way hyped up into the ASX 300, and then index funds will buy it. And then the index funds will make their shares available for short sellers for lending. So people will then short the stock if it's full of hype, has virtually no revenue. So I'm thinking this is like companies this has happened to include, for example, Weebit Nano. Let's not put that in the text, Patrick, because we don't want the Weebit Nano guys coming over to abuse me. But Weebit Nano, Brain Chip is another classic, like all the way hyped, all the way up into the indices, absolute fluff. And then once you get in big enough, people can short you. Okay, people short you. It creates incentive for people to point out, hey, this emperor has no clothes. And then like you've had your top, basically, because as soon as you have an incentive for people to actually say this has no clothes, well, it wakes people up essentially, like, because the people, ultimately you cannot sustain a share price based on like hot copper enthusiasm. So that's the danger. Why do we do it though? Well, it's these huge inefficiencies. You can get Promedicus, which I bought at $86-89 million market cap. It's now like 20 something billion dollar market cap. And that's just one. Like, I guess Energy One, another one we'll touch on today. And I own Promedicus and I own Energy One, but I bought Energy One the first time at $1. First of all, I spotted that at 40 cents, by the way. I first I have to scrape where I first found it. It was some blog, very obscure little blog that I think stopped many years ago, that was just a microcap blog that highlighted Energy One for me. And I remember being at my dad's house looking at it. It was that long ago. And was it 40 cents per share, and it was like, I had to pay up to 48 cents to just buy some shares, and like the last traded was 40, and the highest bid was probably like 36 or something ridiculous like that. Anyway, so like I understandably chickened out of getting into this lobster trap. But I did buy shares eventually once it like improved a little more, got to $1. Okay, it's $1 now. It's $10 now. And that wasn't that long that I bought. It's like 2018 or something like that. It was $1. And we're like 6 years later, it's $10. That's a 10 bagger. Like these things can move the dial for your life. In fact, I have my entire, like this is everything that I did was just get lucky on small caps. If I get one more Promedicus, then will I even do podcasts after that? Like probably not.
I hope you still would.
It's probably better for my sanity if I just like completely descend into like a gardening at that point.
Gardening's good for everybody's sanity.
Yeah, I still don't have my tree house. Well, I've got one kind of tree studio, but I need an actual tree house that's in a tree. Then I'll have really achieved it. Anyway, I diverge. Promedicus News today put out a $20 million contract win. The share price, I think what we calculated, moved up enough when I looked at it earlier today. What did I say it was, Patrick? Like 1.2 billion was the increase in the market cap today in Promedicus?
Yeah, I think that was the number you were throwing around.
It is actually true because it's a 20-something billion dollar company and it went up like over 5%. So you're talking over $1 billion move. Well, it's down. It's only 4% now, but in the vicinity of $1 billion because of this $20 million announcement that came out. I can only assume that like the Momo algos or whatever, like picking up a contract win in like a Momo high beta liquid growth stonk is the word for these kind of companies, a stonk. And so what this ratio of so this is tax loss for the absolute nerds there, that there's this tax loss guy who has, what's his blog called again? Tax loss's blog. Substack, tax loss Substack. Comes up if I put it in. It's taxloss.substack.com. You got to read it. If you're in small caps, you have to read. He calls his blog Today in Bullshit. It's great. He's been covering Jeff Wilson's WAM stuff lately, but he also picked satire, picked that apart absolutely correctly. Honestly, one of the smartest guys out there. I don't know why he does it. He must actually care. Anyway, that's brilliant. He come up with a stonk ratio because it pisses him off so much, apparently, that the Promedicus share price has departed from reality. And that stonk ratio is, the ratio between the value of the contract win that Promedicus announced and the amount it went up in market cap. So today we have a stonk ratio of 50. I personally have always been calculating these stonk ratios ever since Tax Loss started teasing me about it years ago. And I'm telling you, if the stonk ratio is high, it means you're in a bull market for like growth stocks. And if the stonk ratio, it sometimes goes negative. Sometimes the share price is down when they put out some contract announcement. That's pretty rare, but it does happen. And that's you're in a bear market for the growth stocks then. So look, that's my rule of thumb. We're in a bull market for growth stocks now. I wouldn't be chasing too hard. Tom Richardson asked me to comment to a Livewire article he did recently about Promedicus, and they put me up against Luke Larrative, who's Mr. Everywhere right now, and he was basically saying, the exact quote from Tom's article is, so first of all, I was featured under the still bullish tag, even though I said, it's expensive above 250. Well, we're almost back to 250. At the time Tom spoke to me, it was 204, right? So getting back towards where maybe it's like a less insane, certainly not a sell at that price for me. I had anymore. I had, previously I'm not buying at 204 either, but I wouldn't be selling either. I think. Anyway, Luke Larrative was basically, says it's another example of where everyone has positive views about a company. But I think it's ironic because he's like in Livewire having a negative view about it, and he's saying, everyone has a positive view about it. Anyway, that irony aside, I think that the biggest problem is he's talking about the PE ratio. Well, mate, the price is not going on the PE ratio. The price is going on international money flows into high growth, high beta stocks. Yeah, that's why it goes on the flows. If you want to decide is the Promedicus share price going up and down? I hate to say it, but probably right now, just overall risk on, risk off sentiment is more important than the PE ratio. And hey, I don't write the rules. Like, it would be cool if there was this like book that said, hey, these are the factors that are going to move any given stock at any given time. And just because you read a Benjamin Graham book, that means it's going to be on the PE ratio or the PE price to book ratio, or whatever. It doesn't work that way. Like, is where it's a social beast. It's changing what, is in vogue in one decade might not be in vogue in the next decade. And
I mean, if it did, markets would be perfectly efficient all the time anyway, and we'd have no opportunity for alpha.
The point is that markets don't always make sense, and I'm calling it as I see it. I don't think it's the PE ratio, being a bargain. I don't think it's like the future earnings that are driving the Promedicus share price right now. I think it's like money flows into a certain kind of destination, which is like these Momo growth stocks. And if people are going into that, then the share price goes up. If people are going out of that, the share price goes down, more or less. Obviously, over the longer term, it has to continue to grow to be one of those Momo growth stocks. If it stops growing, it stops getting those flows, and wow, it's going a long way down. So, the fundamentals matter, but they matter because at the moment, Promedicus fundamental growth is so good that it's sort of in this sort of market darling category where in the short term, its share price is going to, like, it came down from 300 to 200 because of all this, basically because of flows, and it came back up to 250 because of flows. I personally think even at 200, I say in that article of Tom on Livewire, like, I still think it's overvalued. Like, don't get me wrong, but whatever. It's a good way to get exposure to that factor, and it's not my largest holding anymore. That's enough about that. But that is why I invest in small caps. Yeah, that's me. Like, I get lucky once in a while. So don't put all of your money in one small cap. Is an insane thing to do. Like, so on that note, let us move on to some small caps that, at least some of them, I think have decent risk reward. I'll start, since I've been yabbering on for ages already. I will start with actually, do you know what? Let's you have a go now. We'll come back to me. Let's hear you talk about 3 stocks that you think that you chose in your recent Livewire article. You chose 3 stocks that you think could be beneficiaries from the Labor election win.
Yeah, and I want to qualify that first, that I'm not necessarily saying these are great investments. Some of them probably are, and some may not be. I was looking at it purely through the angle of like who benefits. So there were a couple which we've spoken about before. I can't remember if we've spoken on the podcast or just written about them, but
no, I don't think we have. The podcast's pretty fresh. We've written about them all, but in many ways, we're just, I guess, let me reassure our actual subscribers that anything we talk about on the podcast has already been covered in writing. But this is just a different format for people who like to receive their information in a different way.
Yeah.
Also, hopefully a little bit more casual, right? Because it can be hard work to read an article that's like dense on numbers, etc.
For sure. Well, one that I thought was pretty interesting, I've had my eye on it for a while, is Generation Development Group. CEO Grant Hackett, yes, that Grant Hackett has been doing a really great job there for quite a while now. I can't remember exactly when he took over. I think it was kind of 3 or 4 years ago, maybe, as CEO. But one of the products that they do is investment bonds, and they've also been moving into annuities. Some of the government's proposed changes to superannuation, specifically around this $3 million. It's not really a cap; it's more like a punitive tax rate on high balances. Basically, it will make superannuation and pensions within super less attractive to people with very high balances, which will make competing products relatively more attractive, and they offer a product that competes with that.
So I'll just hash the like political backstory a bit, because I've been following it pretty closely. This proposal by Labor is essentially a typical Labor thing. It's trying to get very wealthy people to pay a little bit more tax, which is fine, but the mechanism that they've actually gone about doing it is very administratively burdensome, which involves taxing people on unrealized gains on balances around over 3 million. So that creates a problem whereby if you've got some gain in your SMSF, but you were unable to like liquidate that easily, then you have to get the money from somewhere else to pay the tax, etc., which really is a massive annoyance to not be able to defer. And like one of the biggest reasons that you want to do sort of just investing, for example, is that it does delay that tax you have to pay. Like, yeah, sure enough, you're going to have to pay the tax eventually, but if you just leave your money in a stock and it goes up and up and up, then you're delaying when you have to pay the tax. So that capital you might otherwise have to pay out as tax, you get the benefit of that continuing to compound over time. Whereas if like at the end of every year, you have to be like, oh, my shares are up, haven't sold any, but now I have to pay a certain amount of money. Well, realistically, you'd have to sell some of those shares just to, hypothetically, you might have to sell some of those shares, even if it was as liquid as shares, just to pay the tax on them. And that means, of course, you don't get the benefit of like that compounding bit of investment anymore. So it makes superannuation for balances over 3 million extraordinarily unattractive. Put some money in. Sure enough, it just grew really strongly. And I think it was because people were just even worried that this superannuation thing would go through. Now, in the last government, David Pocock was blocking it in the Senate, which I fully support, by the way. I am make no bones about the fact that I admire David Pocock. He's like an excellent rugby player and I believe a politician with heaps of integrity. And, I think he was just calling it on this, come on, just you can tax super above a certain amount for sure, but just this unrealized gain thing is very unwieldy. It's not a good system. It's going to create unintended consequences and be quite punitive. So
couldn't agree more.
Fully understand and good on him. Like, that's what a moderate should do. Be like, hey, Labor, there's a lot of stuff that I'm okay with you doing, but this bit's really silly, so I'm going to say no. And you could change it and take out the silly bit, and then we can go from there, kind of thing. Well, that was well and good, but it looks like in this government, another option for Labor will just be to get the Greens to do it. And in fact, the Greens are saying, well, your thing's not silly enough. We want it, instead of being on balances over 3 million, we want it to be on balances over 2 million. Gosh, wow, isn't it tiring? The Greens always with this tactic. If you recall, the very first carbon trading scheme, which was bipartisan between, or at least initially bipartisan, the Liberals abandoned it, but it was Malcolm Turnbull had hashed it out with Kevin Rudd originally. It was a good scheme. Greens blocked it because it didn't, it wasn't good enough for them. And then in the end, they actually got lucky and got their really strong scheme through. But then they lost. Then Abbott got into control and took it away, and we got nothing. So it's a bit of a tactic that they use. Yeah, sometimes it's a good tactic, but not always. And we'll see how it plays out this occasion. I don't imagine Labor's going to agree to take it down to 2 million because they're much more wary about being seen as allowing the Greens to bully them in this way now. And also, they do have other options in the Senate as well. Let's have to see what the final numbers are, but it's quite possible they'll have other pathways for that legislation anyway. So but the main point is this legislation could go through now, and that's why Generation Development Group, in which full disclosure I own shares, could benefit from that for sure. Because like if it actually happens, it should drive even more flows into insurance bonds, which do reduce the tax, not as well as super does right now, but certainly better than super will for balances over 3 million if these changes go through.
I do want to make one more quick point about it that I think is really important. It's not indexed. And that is going to mean that the issue will get bigger and bigger over time, which I guess if it goes through without indexation, should actually benefit GDG over time as more and more people kind of hit that 3 million mark every year, decade, whatever. So, look, I think it's an interesting company worth having a solid review of, and there's no question in my mind that the company will benefit if these changes to super get through, and that seems quite likely at this point. Before we get to the next one, though, I just wanted to mention a not entirely related bit of news, but it is about GDG. They just put out an announcement this morning, that they had partnered with BlackRock, including a small direct investment. It's only 25 million, versus a market cap of 1.76 billion when I checked a few hours ago. So, they're not going to own a huge portion of the company, but having, strategic investment and a strategic partnership with a company like BlackRock, the world's largest asset manager, I'm pretty sure, is a pretty big deal. It looks like they're going to be launching some products together, and it's going to be retirement focused. So seems as though it's all related to this theme. So it'll be interesting to see what they come out with there, but definitely worth keeping an eye on that.
All right, brilliant. Moving on, you picked up I love this. This is exactly the kind of thing I have an interest in. Didn't actually like this stock too much, but I loved your research on the next one, Mayfield Childcare. No one's ever heard of it. Fair enough, but that's what we do. We look at these tiny little micro companies. Why don't you tell us the pitch for why you think it'll benefit, but also give us those details you talked about, how like this, there's a lot of operating leverage potentially in this because it's, quite risky and beaten down at the moment.
Yeah, so it's a tiny company, got a market cap of around $30 million. They are a childcare operator, so similar to G8 Education, similar to Nido. They operate a bunch of childcare centres. They've had some challenges in their portfolio of childcare centres, so they are trading at a much lower valuation than their peers. The government is proposing basically to invest in childcare to ensure that more 3-year-olds are able to get into kindergarten. We have that actually throughout Victoria, but that is a state government scheme. It's not in other states. Basically, it just means more kids going to childcare centres more often. It's pretty straightforward, really. They're fully funded places, so, essentially like public school, but it's childcare. It's obvious that would benefit operators of childcare centres. It's a first order effect.
Sure, that's exactly what Mayfield needs from the picture you painted. Like
exactly,
pretty bad company, but it could be decent.
Oh yeah,
it could be a decent company if it just gets a little bit more.
Yeah, it doesn't even need to get decent, right? It just needs to be better than where it is right now.
Yeah, so it's a turnaround. The thesis would be a turnaround, right? And essentially the thesis would be like the turnaround would be assisted by like a regulatory tailwind or whatever, which is obviously, Labor says they're going to do things. Whether they actually do things or not remains to be seen. But given that this one's a bit of a dumpster fire now, if it cleaned up its act, you can get a decent gain out of that now. Trying to pick the top in some childcare center roll up is a fool's game in my opinion. So I'd pretty much just take the uplift if they like cleaned up their act. And
yeah, for sure. Look, they've got a new CEO. They're divesting some of their underperforming centers. So like they're doing the things you'd hope to see when they're doing, when you're going for a turnaround. Like they're trading on a price. Ignore the price to earnings ratio. Their earnings are massively depressed. It's not useful.
I think that, look, anyway, we'll refer people to that Livewire article you wrote, which is titled, so if you want to Google it, 3 ASX stocks to benefit from Labor's re-election. If you do want to learn more about Mayfield, what I liked about that article was just basically you can comparing the valuation with some of the peers, just to show that, like, if they did improve their operating metrics, they could definitely get an uplift. I definitely believe that's true.
Yeah. But huge caveat here is they have not a good balance sheet. They have a lot of operating leverage, and combining financial leverage and operating leverage can be a pretty big risk. They did do a capital raise right at I think it was like on the 3rd of January it completed. So, they're probably okay liquidity wise for now, but if any hiccups, really, I would expect to see more capital raising down the track. If they execute perfectly from here, they might be able to, but I would just really want to stress that
people that are braver / stupider than we are.
Exactly.
But honestly, like, they can get massive uplifts. Like, it could be worth more research. I really just don't like childcare center businesses. at all. I think that I'm biased against it because I basically I don't think childcare or aged care should be a for-profit activity, because everyone wants to get into the community childcare that has a beautiful tree in the backyard and costs less and like just as good, if not better, care for the children. And so I just wish that they were all like that. And it's just like I have this like radical vision for a society that looks after all its 2-year-olds. Anyway.
No, I agree with you. And I mean, it's an important point to mention too, because they're competing with not-for-profits, right? Like Good Start is one of the biggest operators of childcare centres, and they are a not-for-profit. So a company that is for-profit competing with a company that is not-for-profit, either they've got to provide a lower quality of service, or they got to charge a higher rate, or they don't make a profit. Like it's pretty simple maths, right?
And an absolute pickle.
Yeah. But I think that's really all that needs to be said about that one. It's interesting. I probably wouldn't be rushing into it, but I'll probably keep an eye on it.
It's a play. There's a play in there.
Yeah.
I'm not going to do it. I also can't do it. Like, I don't want to do it. Like, that's why I try and talk about more like long-term kind of ideas, because, you know, if someone just buys a stock and then sort of forgets about it or never listens to me again, like at least if it was like a good long-term one, then it should be okay. Whereas if it was like, oh yeah, my idea is like buy it at, you know, buy it at 40 cents and then sell it at 60 cents in 1 year. Like that's 50% in a year. That's good. Like that's a good return. And if anything like what we're saying in terms of this tailwind from government happens within the next year, I just think it's possible. I think there's a thesis there, but I'm just not going to do it because, you know, these companies could also, like, they've got problems in their centers. Like, what if they can't divest them? They get a big write down, or like whatever. There's too much leverage. Like something goes wrong in one of their centers. Like, you know, God forbid a kid might have something bad happen to them or whatever. Like there's just a whole lot of, like, you couldn't do it with more than like just a tiny amount of your portfolio as a bit of a punt. But, you know, one day I will retire from talking about stocks and just take these punts in my, that's all I'm going to do, like in my treehouse. All right, drum roll, please. Hopefully add it in action, because this one is my favorite one of yours, obviously. Like, take us on to the third one.
Yeah, and look, I have no doubt that you'll probably have a lot to add on this one. I know you know this stock very well, but obviously the Labor government is looking to invest heavily in wind and solar, and also in batteries as well. Basically, renewables across the board are marked for investment. Energy One is a provider of software to energy markets, basically. So
I'm going to play devil's advocate on this one because it's like my largest holding, so it just like looks bad if I'm
no, please do. Go
so
for
I'm
it.
Like devil's advocate. They do software, but they also diversified into software plus services. So the idea being that your new wind farm doesn't necessarily want to staff a 24/7 energy trader, so they can just outsource that to Energy One. So instead of them buying Energy One software and employing someone 24/7 themselves, Energy One already has 24/7 trading capacity through Australia and European offices. So they can outsource that. It's obviously not as high margin as software because they have to pay someone to do the stuff, and it's a skilled thing that they're doing. So it's not as high margin as a software company. So you can't really compare a revenue multiple of Energy One with a revenue multiple of 0 and be like, oh, look, you know, it's less as Energy One's is less, therefore it's cheap. It's not the same quality of revenue. But, and here's where it does have some credit, is that it is possibly just as sticky as the software, right? Like, it is a service, but it's not your typical IT contractor in the sense where you'd be like, hey, we've got a project, we want to change this, blah, blah, blah. So there'll be like, you know, 1 to 2 years of a project and then off you go. It is like a very much an ongoing, recurring, like you continue to need the services like 24/7. So, and it's obviously like pretty essential. Like they can't fire Energy One without having an alternative option in place. So
I can't imagine there'd be many alternative options out there either, would there?
There's competitors in every market.
Okay.
There's no monopoly situation. I think in Australia they have around or upwards of 50% of the market. So they're definitely proven themselves in Australia. and I think it's like low, obviously lower market share in Europe, but like there's not that many sort of individual companies that are very strong. It's not like they're a weak competitor. A lot of them would just still have in-house systems or whatever from like a legacy solution that's been worked out. And as the energy trading becomes more frequent and more complex with more renewables, like this becomes like a bigger and bigger deal, which is an opportunity for like Energy One to win more customers, but also like is a testament to how difficult it is to win customers because it is so sticky. Like there was talk of them winning a big German customer a few years ago, and they thought they were going to. They were like prepared, they were preferred or whatever, and then the guys they got cyber hacked, and then the guys pulled the pin on it. So there's been some real downs for them in the past as well. Sticking with my theme of being negative about my favorite company, but I don't want to.
You got to consider both sides.
It's like what's useful anyway. Like the true investor is looking for the negatives. Like tell me the negatives because I got a lot riding on this. Like if there's a problem, I want to know about it so I can tell my readers.
If you want the positives, you can just turn to the management or to the latest investor presentation. They'll tell you the positives.
Yeah. Anyway, my concern is it's a little hyped at the moment. I'm not buying shares at the current price. I already own shares. I still consider it a buy, but it's getting closer to a hold for me now. And certainly my buy more price is much lower. And I don't think that many readers, like subscribers, that is, would be buying this one now because we've had like a huge period of time when we were calling it a buy when it was like $4. And then even once it started creeping up to like $7 or whatever before these results, all of the signs were pointing that these results were going to be a massive step up. So I put out the special article being like, guys, this is under the radar now. Like, it's time, like, if you haven't already. And then, of course, it did have the good results. And then, like, now it's just much more not under the radar anymore. But that, I still, anyway, in theory, putting back to the bull case, like, or not the bull case, but putting back to the point of this discussion, like, I think it would have been really bad for Energy One if, seriously, the country had pursued a nuclear option, because what that would mean would be slowing down the renewables rollout, which is driving their growth. So, like, maybe they could sell their software to the nuclear plant in 20 years or whenever it comes. Like, that's a long, like, I can't wait 20 years.
You're going to be waiting a long time. For supporters, if you do want to know what Claude's target price for Energy One is, you can find an article that's just for our supporters on the website. So go have a look at that.
Yeah, that's my favorite small cap stocks on the prices I'd buy more. Look, okay, great. Well, thank you for that, mate. Mate, moving on. So this is going to be published on Friday, 9th of May. So by way of disclosure, I bought shares on this on the 6th of May, I believe. Or maybe, the 6th of May. And the reason I did that is because at 6:20 p.m. on the 5th of May, the company announced that McGrath Education Centres announces after 19 years, Mr. Storm McGrath's term as CEO and Managing Director came to an end at the close of business day. It came to an end. What do you reckon of that wording? You see that one very often?
I don't think I have seen that. Usually it's resigned due to personal reasons, something like that.
Anyway, so great. That's huge because what is McGrath Education Centres? McGrath Education Centres is a company founded by Storm's parents a really, really long time ago. And it's been listed for like more than 2 decades. And indeed, Storm himself has led the company, his parents' company, for 19 years, as it said in the announcement. Now, if you go and look at the share price 19 years ago, it's basically higher than it is today. And it has paid some dividends in that time, but not a whole lot to talk about. Like, that's an amazing run. Can you imagine, like, how often do you see a CEO, like, not deliver for that long and they're still the CEO? You don't see it.
It's rare.
It's rare. He's a great run for him. It's a whole career, 19 years. Wow. cool. It's like, okay. Anyway, so he was one of the main reasons so initially I got interested in this stock because what had happened was in 2007, when Storm was CEO, they bought a vocational education provider, which then lost its registration. Now they went through like a big battle trying to like re-register it and like restore this business or whatever. In the process, completely ran out of money. So then started to like do all of this desperation financing. So it did at one point it did a rights offer that was like oof, rights offer that I think was like 5% or definitely less than 10% subscribed. Eventually, I think they're like a private equity kind of business. Editure Capital kind of bailed Kit McGrath out, the company. Editure Capital. And where I kind of first started following the story was that Kit McGrath Education Centres had divested this failed vocational educational business. It had been saved by Editure's money. Editure owned a fat chunk of shares, like maybe like 20%. I can't really remember. And they had gotten that at various prices, around 6 cents and then like some of it I know was 6 cents, and 9 cents, and generally like a whole bunch of money they'd got, like investment they'd done under 10 cents per share. The share price had gotten back up to 30 cents. And it just seemed to me that there was a chance that Editure wanted to sell by the end of a certain financial year. I'll see if I can see what it was on the chart just by looking. I don't think I can actually. Can't tell that level of granularity so far back. Oh, yeah, no, it was 2014, right? And because I can still see it on the chart now. Um, and so, and I really encourage small cap investors to keep an eye out for these opportunities in the coming up 30th of June, because sometimes somebody has an incentive to liquidate a position, just sell it completely by the end of a certain financial year. And as the end of the year came, Editure was selling and selling. And I just basically had this suspicion maybe they need to sell out by the end of the FY 2014 financial year. And the stock had been trading above 30 cents. It had a bit of a turnaround. It got it back to profitability. I think it was even paying a dividend. And then there's an opportunity to buy it at 19 cents because they did indeed dump their like holding at 20 cents or just around 20 cents per share on the last trading day of the year. I can't remember if that was June 30th or another day, but the last trading day of the financial year. So that's how I like first like bought shares in it or whatever, and I followed it for years, and I regret to say became far more of a convert to its potential than it deserved, really, in hindsight, because unbelievably what subsequently happened was that after making good progress, keeping the business on a steady track, which is a franchise tutoring business, by the way, if anyone didn't know that, keeping the business on track, growing franchisees, or at least franchisee revenue. There was a big transition of franchisees from what they call silver franchisees that paid a smaller flat fee to gold franchisees who paid a percentage. So once you get enough gold franchises as a percentage, then it makes sense to do a bit more advertising because you automatically benefit as their revenue increases. So yeah, that bit of it was good. But then, they started buying corporate stores, which was a bit unnecessary. And I guess that's like what you do when that you're not creating enough demand for new franchisees to buy out the old franchisees. So perhaps you're not treating the franchisees well enough, or you're not marketing to new franchisees well enough, or whatever. Like either way, you need to have a situation where when they want to retire, franchisees can sell their business. Now, ideally, you do that by like having a great reputation as a franchisee and having demand from other randoms to buy in and become a franchisee. However, that wasn't happening. So Kit McGrath Education Centres was stepping in to buy these centres, which they then call corporate centres, which have been like marginally profitable at best, just nowhere near as good as the franchisee model. Like, suburban tutoring is not the best business. Better to let that have to a franchisee, and then you just like clip the ticket, which is then a capital light business. That's actually quite a good business. Anyway, so they diversified into corporate centers, and then they did like another ridiculous move, which was to buy, of all things, a US business called Tutorfly. The founders quit and like basically started another business. This Tutorfly thing was loss making when they bought it. It's never made a profit. It hasn't even grown well. Like just complete trash or whatever. Like should never have been bought. You're complete. Like why are you buying some? You think you're the smart? These guys live in America, work in America, start a business in America, and they want to sell it to you. You're in Australia. Like how? Like literally what? I don't want to say what I think, but like you must think that you're a real fucking galaxy brain if you're so smart that you're going to be able to figure out what the right price to pay for their business better than they are. Come on. Anyway, they wouldn't stop digging after this Tutorfly thing, which was a few years ago now, and ultimately was like what caused me to sell, having like ridden the stock all the way up and then back down again, basically. I was like, oh, this, I can't backstorm. This is insanity. Like we just got things on track, and then he goes and yeets it all into some like loss-making US acquisition. Then they even opened, I think, a physical franchise center in the US like about 6 months ago, which is also unprofitable. So just throwing money away. Why? Why? Makes no sense. Anyway, I was very grim about the whole thing because Storm himself owns 10% of the shares, and I'm pretty sure his family owns a certain amount as well, maybe around 10%. And so I was like, oh, they'll never get rid of him. But then he's gone. He's gone. So I was like, well, this just got interesting. And that's why I bought some shares. Yeah, so basically we're going to talk quickly about Raise Invest, which is a small $65 million company. It's like really it's a funds manager, but I guess its angle is that it's like an app that makes saving, like I guess gamifies saving a bit and makes it easier and tries to use a whole bunch of like nudge technology and stuff for the good of their clients, which is to actually make them save money. So rather than spend money, having automated savings means that essentially people can't impulse spend that amount of money. So the way its initial gimmick was that it would automatically round up transactions. So if you bought something for $58.50, then you would put $1.50 into your Raise account. And then they have various other automated plans, and they've got like other gimmicks like jars, like you're saving for this in this jar and that in that jar, and they have a bunch of basic investment options. I don't imagine they'd be appealing to anybody who necessarily is a small cap investor because they're pretty, I guess, passive options.
Yeah.
But at the same time, hey, it's totally a good little gimmick that plays on the angels in people's nature. So that's cool. And I really like that about it. And for that reason, I've always wanted them to succeed. And yeah, like why don't you take us away for the quarterly update?
Yeah, I mean, I would just agree with that. I've used the product before more just, kind of out of interest and researching. And I think it's a cool product. I don't think we're the target market for it, but I think for those who it does suit, it's a good product. And I particularly like a new product that they've launched relatively recently. It's like a Raise Kids thing, so kind of saving for kids. There's not a lot of options out there. Funnily enough, one of them that we discussed earlier is investment bonds. But, for parents of young kids, it's good to have more options out there in the marketplace. But in terms of the quarterly result itself, it was pretty positive, really. They had active customers grew nearly 7%, 6.9 to be exact, year on year. Revenue per customer up 5.9%. Net inflows quarterly of $60 million. They're basically the key metrics that are going to drive the long-term, growth and profitability of the company. So,
it's FUM and customer numbers as well. So, you have to look at the active customers, and then if you want to dig into customers even further, you see actually in the most recent quarterly, the superannuation customers were up 5.8% quarter on quarter. And look, that's that's their smallest segment, because that's whatever 13.3 thousand super customers compared to 325 of the just general customers, which is that they've built up over time, and then even 50,000 of the kids portfolios which have proved popular. So obviously segments like the kids portfolios and the super customers are very valuable because they'll be adding to those for a really long time. Another thing is not that long ago, I guess over time they've ARPU's been going up, and the company did put up just a pure price rise a couple of years ago, I think now, which didn't create much churn. So I do think there's some pricing power there. Having said that, they're already pretty steep on the fees. You definitely aren't using Raise because you want the lowest fees. You're using Raise because you want the highest convenience, and you just want to do something, right? You're not saving at all. This is a really easy way to download on your app, put in your information, get it set up, and then you're done. It's do one thing, and then it's going to automatically help you save over time. That's what I like about it. And that's why, even though this fees might not be most competitive, really the target is people for whom the barrier is just the time and effort of sorting out their financial affairs. That can be a major barrier for people. So anyway, I've always been biased towards it because of the product. There's some cool and ugly and interesting history there, with one of the co-founders leading a multi-year wasteful jaunt in Southeast Asia, which is now over. The thing just definitely seems like it's on a better path now. You could definitely. I don't own shares in it at the moment. In fact, as I said, I'm sort of steering clear of these lower conviction ideas at the moment. I've really just slimmed down to the higher conviction small caps. But definitely think that this could one day turn into a decent business, and it's definitely headed in the right direction, in my opinion. Currently, still not profitable though. Blah blah blah. So you definitely need to put this in the super high risk basket.
For sure. Did you want to take us into the next one?
Now, this is not one that I've even written about and covered before, and even thought it was a buy at much higher prices. So full disclosure here, I've been completely wrecked on this one. I've never made it an official recommendation or anything, but I was long the stock for a while, and I lost money on it. I'm 99% sure I definitely did.
I think it's probably worth mentioning what they do, because I don't think people generally know know the company by name. So I don't know if anybody's ever been in the back of an ambulance, maybe, or sometimes you might see it at the dentist, the little green whistle, which contains pethidine. That is called Penthrox, and that is their kind of main product. It's been around for a really long time. I actually only learnt a few years ago that this is not a thing that's found all around the world, and it's actually a fairly uniquely Australian product. But they have been looking to try and change that and distribute it overseas.
So there's that. They also have an asthma spacer business, which I guess is over the cycle profitable, but is generally quite a bit up and down, because it sort of just depends on the ordering cycles of distributors, etc., etc. I'm an asthmatic. I've used their asthma spacer product, and I've used other asthma spacer products, and I think their asthma spacer product is really a bad one, and I would not buy it again. It's super annoying to clean compared to its competitors' products. And if it's cheaper, I didn't notice. Maybe it's cheaper, maybe it's not. I have no idea. I'm not going to notice the difference between $20 and $30 when I buy an asthma spacer, which I replace once every 3 years. I'll definitely notice if the asthma spacer is filthy and I don't want to I don't want to breathe in it, because it's just I can visibly see all of the gunk that's caught in the bit that I can't get washed out. So yeah. Anyway, I don't value that business at anything. I was looking at my past trades on this one. So yeah, I did get wrecked on this. I had bought it at $3.50-ish and even higher, and then sold it $1.30. So it's actually, in a percentage terms, one of the worst losses I've ever made. So I got a little bit of jokingly PTSD on that one. Although I didn't learn my lesson, because looking at my trade history, I bought shares after the January quarterly, which was a big improvement as well. And then it re-rated quite aggressively, and then I just sold it after it re-rated. And
so it hasn't really been your portfolio MVP then?
No, not at all. And honestly, I think I'll probably just I've been maybe I clawed back some of the money I lost then, but I should probably stop dabbling on this one, because I've been wrecked in it so many times. Now I've said that, it'll probably go on a multi-year turnaround story and 5-bag or something. So I don't know. I feel like this Penthrox business is actually a good business. And so the new management, what they initially did and how they drove the share price from $4 to 60 cents is that they decided that they were going to try and get this stuff reapproved in the USA. And they wasted millions and millions of dollars doing that before basically giving up, because they realized that it's going to cost so much and take so long that they just basically they're going to run out of money. Basically, they were going to lose money and run out of money. They need more money for it, but then their share price was low, so they couldn't just raise money. So yeah, the whole thing was an absolute schmozzle and does not reflect well on the current CEO, in my opinion. However, I do think that the course correct that they've done is a good course correct, and their strategic priorities have been most recently outlined in the quarterly report that was put out very recently, and it was a good one. So let me take you through the highlight. 1.7 million operating cash flow, not much investing cash flow, only about 227,000. So yeah, it looks like it's gone through to free cash flow positive, which is a huge deal. And that in itself could just this business historically, based on what it has now, is definitely capable of making a few $1 million profit a year. If we look at the long-term historical financials, before they started getting excited about this America thing, they were regularly making a profit of over $1 million a year. It just never really got to that next level. So at the moment, its market capitalization is 70 million, so it needs to get to $2 million profit or whatever. But I think if it did $1 million, then it could potentially do $2 million, especially as its sales have increased. So if we look at its old margins that it was earning and then apply them to its current revenue, I'm talking quite deep in the past before it started spending heaps of money on this US stuff, then I think that it could definitely justify its current market capitalization. So turnaround seems to be happening here. I don't know. I'm not fully excited about it, but I think if you're going to buy this thing, you want to buy on it assuming that it can make at most $2 or $3 million profit a year. There's no real good reason that I can see that would make more than that. So that does put a bit of a cap on the price you would pay, which is sort of hence why I kind of took my profits when I did trade it when it started to turn around. So yeah, anyway, that's it. It's on the right track though on a fundamental level. Not really. Got no strong view about the share price, but yeah, this was a better quarterly. And the other final point I'd made is you just got to be a bit careful when the success does come from the asthma or the respiratory section, because I think that is sort of basically lower margin and probably a little bit more subject to the whims of distributors and stuff like that.
Great. Well, we'll be back probably pretty soon after this one, because we've got a bunch more companies to cover.
Yeah, we didn't get through everything at all.
No, we didn't even get close. But it's up to us when to come back, so we'll make sure it is soon.
Have a nice day. Let us know what you want us to talk about. I think is probably the most important thing, whether it be in the comments or just email us or whatever. Let us know, give us ideas, because we're going to go through our list of quarterlies we want to talk about, and then we can start doing requests. So I look forward to hearing from the listeners as much as possible. Just leave us a comment, please. Would much appreciate it. And also thank you so much for the people that gave us 5-star reviews on the podcasting apps and stuff like that. It makes a world of difference for us. So
It
thank
really
you very
does.
much, and talk to you again soon.
Sure will. Talk to you soon.